What's up, YouTube? It's Joe Catchpolia sitting on the couch making some money investing in fractional real estate online, as usual. Today, I had a kind of funny interaction with Jerry on, Jerry, the founder of Lofty, just on his Discord. I usually don't put the Discord messages up on my videos, but he is the founder there. It's his Discord. I don't think he's trying to keep any of his discussions private. If you happen to watch this, Jerry, and you disagree, let me know. I'll take it down. I won't post your stuff again. But this was one that really struck me. We were having a little bit of a back and forth. Um, Somebody had brought up Mogul, which I think is all is one of my favorite platforms right now, probably my absolute favorite for buying just good deals for long-term money. And so we were talking a little bit about what I think that they could learn from Mogul, and I just had given one example, and he had brought up their pad splits and how But one of the things that he said, and this is what really struck me as funny, he said, "Yeah, you seem to like high unlevered cash on cash, but not at the cost of increased risk by having the property in a low quality neighborhood." Um, this struck me as very funny to describe this as a preference, like that I seem to like that because it's so deep in my brain that like this is how you evaluate a deal, right? This is like, is it a good deal fundamentally, right? Does this deal produce good income? And because I'm looking at these deals as these aren't deals that need a business plan, right? They're just basically like fixed income investments, to a certain extent. There is some upside, but they're not. It's not the upside of some business plan risk, typically, or like changing the property or doing something like that. It's really, we have this in place income, we have this in place property, and we're just we're expecting it to go along. And so in that context, yeah, I mean that's how I think that deals should be evaluated. And honestly, it's hard for me to come up with another, other than if you're just and he mentions even, the only, seems like the way to do that is like, okay, you can do a pad split. Or if you just get a really, if you're buying a really killer deal, like you just have a really good purchase price, right? And I think that for a lot of investors, especially in the residential space, they would agree that like the way you get a good cash on cash return is just paying very little for the property, right? You just get a good discount. And that's why you have this huge focus on like off market deals. You have a focus on, value add deals where you want to fix them up, and so so you create some value, and then you get a higher return based on that. But on Lofty in particular, this isn't happening through a purchase of a property, right? You have the co-owner already owns that property. In theory, it's already stabilized. They're bringing it to the property, and so in that context, I'm looking at this as a fixed income asset, basically. Like we're evaluating, okay, this is the yield, and I want to know how durable is that yield, and what, on a risk adjusted basis, how good is that yield? I was looking up different stuff online to find this, and I thought this was hilarious, so I wanted to share this. This is a blog post that I wrote in 2011, so 14 years ago. Look at what a young nerdy kid I was. I was wearing a suit, wearing a suit to work every day, writing about just you know real estate topics in my blog. This was really my business development endeavors back then. Um, but so this was, I was trying to look up different levels of, and this is in commercial real estate, how people normally talk about it. You have your core plus, your value add, and your opportunistic. And your core is just like the most low risk assets where you're buying something. There's just income in place. It's guaranteed for a very long period of time. So like the example I used here was like central business district office properties with long-term leases. What's funny is that after COVID, I think a lot of people don't look at the risk of office properties the same way that we used to, especially in downtowns. Like, I mean, that's really got turned on its head. Then, Core Plus is a similar asset, but like there's some reason that we might be able to increase the NOI. Maybe you have one tenant that's going to renew soon, and they're way under market, and hopefully they renew, but maybe they don't. So it's not exactly core because you've got that risk, but you have the ability to increase the income. Value add is like, a lot of times, people think about this in multifamily or in I mean, you can do it in any type of business. You can do it in, but I think the multifamily example is the easiest. Is like I'm buying an older apartment building. I'm renovating the kitchens and bathrooms. I'm doing a little bit of landscaping, and I'm bumping the rents quite a bit, right? That's normally value add. And then like opportunistic is, they throw in ground up development with this, or buying extremely distressed properties. Um, Anything that you need a bridge loan to actually make it work, probably falls in there. Although, if it's a deep value add, then you might use a bridge loan too. But anyway, I think that same like type of thinking just really, I mean, you can see like I've been talking about this forever, since I was a younger nerdy guy. I mean, even then I had already been in the business a little while, but not forever. Um, but it's why like I know I take a lot of this for granted, right? Like, I mean, maybe you just think, yeah, I'm old and set in my ways, and I think part of it is that, but I also think that it is just like I've been looking at real estate deals for so long, it's hard for me to not look at them the way that I think that you fundamentally should. And so, like, one of the things that really started back in taking finance classes was when you're evaluating investments, the first step you should always evaluate, compare investments to each other, ignoring any type of financing, right? Because we're looking at the actual value of the investment. Whether or not you can finance it shouldn't be part of the discussion of that value. We know in practice that that's not really how it works out because assets that are easier to finance, people tend to spend more on. But at least on a basic fundamental level, I think it's a good first place to start, right? And so mm, so yeah, it is what I'm always looking at. And so like, what I think a week or two ago I did this video where I got on Mogul and I got on Lofty and I showed you like, hey, look at these, our unlevered cash on cash yields on Mogul properties. They're all high. I mean, this is one of the lowest ones I think that I had found. But most of them are very high. And I think on this one, it's one of their lower ones, but they're being super conservative in my opinion. When I pulled the Air DNA numbers, it looks like that they're setting themselves up to really crush it on that one, right? But I mean, like if you look at a lot of these, let's look at another one that I bought some of. And remember, before I forget, please like and subscribe. Uh, in the description of this video, there are links to all the sites that I currently invest on in fractional real estate. Just because I invest on those sites doesn't mean that you should. Just because I buy a specific property doesn't mean that you should. You should really, look at them all on their own merits, do your own due diligence, and think about your specific situation and if it's a right investment for you. Also, there's a link to the Discord in the description to this video where you can jump in and talk about all these different platforms that I invest on and some that I don't. And we've got close to 100 investors that are in there on a regular basis talking about this stuff. So feel free to join that. Okay, back to it. Do the thing with the bell if you didn't do that thing too. Um, so like, yeah, if I was going through, okay, this is another one. Okay, unlevered cash on cash. I picked another one that was on the lower side, but 8.57%, still very, very strong. But a lot of their unlevered uh, cash on cash returns are just fantastic, compared to when I was going through Lofty the same day, you'd see like just really anemic unlevered cash on cash returns by comparison. I mean, there are a few um, exceptions, but in general, that's I think a pretty fair comparison. And so a lot of the returns on Lofty is coming from, the financial engineering, the way the debt's handled. And so when I look at when I'm looking at that deal on a fundamental basis, ignoring financing, um, of course, one deal looks much better to me than the other, right? And I think over the last couple of months, it's really, been proven that we do need to ignore the financial engineering because that stuff falls apart pretty quickly. We're seeing that in the Yome properties. We're seeing that with Brownfield, where there were rent credits or there were, or there's a co-owner that's supposed to be paying the mortgage, but it's now not. Uh, you know, that sort of setup, or maybe they just can't, right? Maybe they get to a point where they can't. That sort of setup, it's important to understand, does that deal work on its own? And so, yes, I definitely have a strong preference for that. But it is, you know, like I said, I mean, to me, that's not a personal preference. That is how you evaluate, you know, real estate. If you're looking at real estate as a fixed income, right? If we're looking at sort of that core plus, right? And that's the only real option we have right now with, um, you know, with Lofty, with like Arrived Homes, and I think Arrived Homes is a really good example. Like they've just leaned into, okay, we're offering a core product, right? They're saying what they're trying to do, all they talk about is safety. They hardly, you know, they bury their returns in a lot of this stuff, right? They're just like, it's safe. You know, we're a Jeff Bezos backed company. We're buying nice new properties. You know, we're picking strong markets. Like all they're really talking about is the safety of it. They talk about, you know, okay, there's less regulatory risk because we're spending all the money to do, you know, to actually offer securities. Um, oh, but by the way, once we get to the financials, you know, they're really low, right? Or the returns that they're offering are very low relative to a lot of the other platforms. Well, if you think about it in you know these terms, core plus, value add, opportunistic, they're really just trying to be the core asset, you know, of residential fractional real estate, right? They're just trying to just focus on safety, on consistency. You know, just you and a lot of the people that I know that are invested on here, that's all they talk about. They're like, I just keep getting my payments. You know, it's they just keep coming and they don't care that it's a low return, you know, relative to other potential deals out there. And so I think that, you know, they've really just embraced that. Um, I think if you really think about what Mogul's doing, the thing that's different there is they're doing it as a purchase. And so some of the times we might be getting a little bit of a discount from market value, which is not always the case. But then the other thing that they're doing too is they always have a business plan and they're buying existing pad splits and existing short-term rentals, but they're using you know, these are both business plans that don't really fit with that core concept, right? You don't have a long-term lease. You know, you have very much more turnover, so you're taking a little bit more risk. You have some more business plan risk. Um, and so it, you know, it does depend a lot more on the execution of that, right? Like not just anybody could take over this property and run it as profitably as they, you know, I expect them to with their partner. You know, they have Pad Split doing that they've partnered with on a lot of deals. As you know, they're doing a lot. They do the basically the um, guest acquisition or the member acquisition is what they call their tenants, basically as members. And then they also have, you know, you have this team of the mogul team themselves that are actually the ones that have the real estate experience and really will be the ones that, if there are issues that arise, will be the problem solvers, right? And so that's one of the things. Um, so they're able to focus on, and if you look at what they're buying right now, they're only buying short-term rentals and pad splits. And the reason is that those are the only two ways that in today's world you can buy single family homes in good markets and have good cash on cash return, right? And when I say good markets, I mean growing markets, markets that I expect to outperform in the long run. And so what they've really focused on is two business models that are working today relative to, you know, everything else that's just not working quite so well, right? I mean, because of where interest rates are and prices are relative to rents, long-term rentals don't make a ton of sense unless you're, you know, the people that are getting, you know, like that are buying long-term rentals today are doing it either they're making a lot of offers, getting big discounts, or, you know, like I think M1 is a great example, right? He's still out buying regularly. He is really on the value add, but more even opportunistic end of the spectrum, right? He's just always trying to get himself a fantastically low deal. But by the time that property is brought to Lofty, he's already executed the business plan, right? It's got a tenant in it. You know, he might, in some of the ones he put out, he did mention some ways to add value. But for the most part, you know, he's already done the opportunistic part, and we're getting the fixed income part of the deal. And so when that's what I'm comparing, yeah, those are the things that I want to, you know, that's all I'm going to compare, right? Is the cash on cash on an unlevered basis first to see the health of the deal, and then also too, yeah, I don't want to be in a low quality neighborhood or in a market that has a shrinking population or all those other things that I think add to the risk of the deal. And so where does that leave us, right? Like, and that's one of the things that you hear me say repeatedly, like, well, Mogul, the reason I like them a lot is because they've just consistently found good deals, right? I mean, they basically are putting out a deal a week, and they're putting out deals. And I skip some of these. I don't buy every single one. You can see I've invested in that one, and that one, and that one. I didn't invest in that one. I didn't invest in that one. I didn't invest in that one that sold out. I mean, so these ones I did. So I skip some of these. I don't think every single one is perfect, but on average, I buy at least two out of every three that have come up since this platform's come out. On Lofty, I've looked at every single deal that comes out has come out since I joined that platform, and there's really only one that I bought close to the $50 price point. I bought some of it's a fourplex in Denver. I didn't even buy it when it first came out. I bought it when there was a tiny dip, but I basically paid full price for it. I mean, it's a little tiny dip. And I didn't do it until Earl took over and was looking at ways to add to the revenue a little bit by doing rent by the rooms in some of the units. So that's what I think. If that's what I think is going to be, that's what I think is the biggest challenge for Lofty is figuring out how to attract those types of deals to the platform, right? Because me as a co-owner, if I have a property, like I can't imagine ever bringing, an asset that I own onto Lofty the way it is right now, right? Like, if I have a great deal, I don't really need to share that deal. Like, it's tough to see, if I were in growth mode, it would be different, right? If I really needed to sell some equity to go buy the next deal and I was living on the fees that, from me managing it. But if all it is that I'm selling equity at a 5% markup, it's hard for me to understand why I'd want to do that on a deal that I think is a great deal, right? If I think I've really squeezed all the juice out of this deal and now it's going to just coast, well, okay, I can see putting that on there. Getting that 5% markup, taking a fee for managing it and moving on. But if that's the case, like I don't see why I would bring one on. Like for example, if I'm M1, I don't see why I buy one. When he's buying a property at 70, can bring it on the platform at 105, and maybe in the future we sell it for 110 or 150. Maybe there's still a little bit of upside left, but like what's in it for him to bring it onto the platform at 70, right? Like, okay, he did the work, he got this fantastic deal. It's hard to see the how they're going to get that sort of alignment of interest between the co-owners and us, because the reason that Mogul is in different shoes is they're not buying it and then selling it to us. They're buying it along with us. They're actually just taking a fee for doing it. Maybe Lofty could look at that model, sometime in the future where they, okay, and I know Earl already did that with the Hawaii property, right? Like he got it under contract, raised money on Lofty to do it. I think if you see that more, then we could potentially see the situation where there is sort of this, we're all in this together, we're all enjoying the upside or enjoying the great discount. Although on that deal, I mean, they sold a lot of the equity at a pretty good markup, so it looked like. I mean, it looked like it was like $65. It wasn't all sold out at 50. So maybe you're not really in the same shoes, and so it's tough to see. And I understand, right? Because if people are going to pay 65, why would I sell it for 50, right? So if it's not set up in such a way that you just have to do that, um, but it's I think it's limited. I think I don't know how big of a market there is for. Well, I think there's a huge market for the core, right? I think Arrived has shown that, right? I think they're the biggest platform that is doing this, and it's also why there you see all these Arrived clone, sites popping up, because people are buying that, right? They're like, okay, they really just pitch it's low. Yeah, I mean, like if you look at it, you don't even see a return anywhere on here except for in their funds. Oh, even their funds now don't show the return on there. Um, but they focus on like long-term wealth creation and whatnot. And I think you could do that, but if it's hard to do that as Lofty because there is, even though I think that they really, like they talk about, they spent a lot of time dealing with the regulatory risk because they're not doing it as a security. uh, a lot of the really risk averse investors are are scared of Lofty. I mean, that's one of the things one of the questions I always get, right? And so like, okay, so you're not getting those most risk averse people that are willing to give up some safety for um, for income, right? Or they're giving up the risk averse people that are willing to give up income for safety, right? But then you're not in the shoes of you don't have like the we're all in this together type of situation where we're just buying into a deal and out there like just finding fantastic deals, like what you've got Mogul doing. And so, I struggle to see like exactly. I mean, I think their product works for the co-owner as exit liquidity for now, right? I think that's what it's more than anything. They're providing a service to those co-owners, and I mean, we've seen that, right? Like over and over again, there's waves of people dumping properties. That you had like the turnkey guy doing it, and then like there's just a lot of properties that have really been basically dumped on here. People sell out at a good price. Um, so I think that is where long term there's going to be some struggle. Like once the sort of people that came here just because it's novel and new and it's crypto based, once that supply of investors dries up and you have people that are really like thinking about this from a real estate perspective, it's hard to see where you go, right? Because it is okay, it's as it stands now, if you're just bringing properties to the site, well, it's got to be, you don't have like that entrepreneurial value add, like we're, and so, that's the other site that, does that basically is Fractional, right? Like fractional.app is where, okay, if I want to go buy a property and I want to raise money for other people, that's really what that platform's made for. Although they seem to have just attracted a bunch of grifters in my mind. I mean, or not necessarily, or novices, or people that you know, people that I would not lend my money to do a deal. Like another, I haven't. I looked at a lot of their deals. I couldn't find anything compelling. I only looked at a couple that. Oh, there was one. There was one. Lending to a flipper basically, or investing with a flipper. But then another one from him never came up. But it was really the only one that I saw that was like, okay, that makes a lot of sense. So if you don't have that, right, if you're not doing it, it's hard to understand where the what hole in the market for actual real estate deals we're filling, right? And I think that that's what and one thing, and I think that their response might be, well, we're just a marketplace, whatever people want to bring here they can. um, but the result of that has been horrible so far, right? I mean, we looked at yesterday that the average token is like $35 and change, right? Meaning that it's gone down close to 30% on average. So that idea of like, hey, just let anybody bring stuff here. Well, if you become known for the place where people go to lose money, right? Like co-owners sell out and investors lose money. Well, it's really tough, I think, for that to work long term. Um, I don't know. So I think that that's really where the crux of their issue is like how do you attract that with and I think in my mind what actually is the right answer is to create, even though it's to really go for that. Okay, this is a secure investment. This is safer. It was kind of interesting when in this part of the same discussion, Jerry was mentioning like how he thinks that their approach to the regulatory issue is a lot, is more sound than what Mogul's is. And I don't know that kind of stuff is I just try not to get in the weeds too much about it. I think that from my perspective as an investor, I'm not very worried about it. I'm not going to get in trouble for securities, violations, right, for buying this stuff. It's going to be the platforms themselves, and that could put some risk on, where the platforms go. But so he's already saying like, well, we're already, we're safer from that perspective, and so like, okay, if we're going to go for, being a safer alternative, I mean, that is like what Arrived's doing, right? But I think that there has to be um, more a larger focus on forcing transparency on the co-owners, forcing transparency regarding the property, forcing transparency, versus like just letting the DAOs, oh well, you can vote or don't, especially because early on, right, when the co-owner first brings the property, they don't ever have to sell out too much of their equity. So they, even though they can't control it fully with the way the scaled voting works, with one or two other investors that are on their side, they can essentially do what they want. And so from that perspective, I mean, I think we have a lack of control, and there's it's creating more risk. And so because there's like a really a strong imbalance of power initially, the way to so whenever you say, "Oh, well, the DAOs, you can just vote for whatever you want," well, you really can't, right? I mean, even if most of the individuals who bought equity initially, other than the co-owner, wanted to do something, it doesn't really take a whole lot. If they retained 50 or 60% of their equity but sold 40, and there's 100 people that own that 40, and they get like five of them to agree with them, I think we're pretty much doing what the co-owner does. I don't exactly know how the scaling works, but that's what it looks like to me, right? It looks like that they can have quite, they don't need a whole bunch more people on their side to shift things in their direction, especially where you need a super majority vote. And so I think that a lot of these controls, like I think it's just saying, oh, you can vote for it if you want to, doesn't really make sense. I think they should just be forced into the platform. Like if you are, in order to list on here, you need to provide XYZ as far as documentation. Bank statements need to be uploaded monthly, like all of these certain things that give us the transparency that we're maybe not getting. So like that's one of the things on Arrived, they it's like really opaque, right? And it's funny that like I don't know at all what's going on with the property except for like quarterly updates, and I know when I get a dividend, right? Like I mean, it's very much and so I think that creates some uncertainty that you could like sell against, right? Like, oh, on here, you do have some control, which I think it's good and bad, right? Like, I mean, they pitch that as like, oh, you can propose whatever you want, but yeah, but uh, all of us, if you've been on Lofty for a while, have experienced being in a DAO where you definitely have uh, a group or several owners that just have just really irrational thoughts. A lot of times it comes from they bought the token at a price that never made sense, and so now they're just trying to get back to it. But so I don't know that that really is the benefit that people think or that they try to pitch it as. But I think that from an actual transparency basis, they could be have the ability to really crush it more than a lot of the other platforms. And so if we focused on that, I don't know. I mean, I don't know that that's a great solution because you can tell. Like I told you, this is going to be kind of just a rant, and I'm sort of doing some thinking out loud here. But like Mogul is already doing, they're pushing for more and more transparency. They're going to end up, one of the things on their roadmap is to um, put your what are they called? Your reserves on chain, right? Like I mean, they're trying to do all these things. So they are also, I think it's hard to outcompete them from a transparency perspective, although certain things we don't get to see before we buy, right? Like we don't get to see the appraisal. They tell us if it appraised or not. So on Lofty, I do get to see that appraisal. I know they talk about, oh, well, on here we have a lot of liquidity. But it still feels very much like fake liquidity to me because it only comes, because of the way um, slippage works and because of the amount of fees, you lose so much. You give up so much if you try to liquidate that. I don't really buy into that being some huge benefit. And both or almost all the competitors are looking at ways to create that secondary market to sell them. And so I don't know that that's going to be, um, I don't think that that's a competitive advantage that you can sit on, right? So I think in general, they, in order to continue to exist as a platform, you have to figure out a way to make it so that you are bringing on good deals, right? And so you have to figure out, okay, where on the spectrum are we going? And maybe it's going to be, well, wherever co-owners bring stuff. Um, I don't know. It just doesn't seem like it works to me. I guess that's really it. I guess I don't have a conclusion. I just had a lot of thoughts I wanted to throw out there. Um, I am curious what you think about that. If you see Lofty's role in the marketplace differently, I know maybe Earl would be like, well, they're the most decentralized, right? And I think decentralization is um, it definitely reduces some risks, but it creates other risks, right? And I think the risks that it really creates is you have, nobody's driving the bus, which can be problematic. Um, you have a somewhat uneducated, large group of investors that maybe can be swayed one way or another based on something that sounds good but is not a good plan, right? So you don't like have that sort of experienced person moving the deal along in the right way. So I think that decentralization it's a trade-off, right? I think it creates some safety, but it also adds to some risk. Um, but it is, I think it's something that like some people really uh, like as a, in theory, it's fantastic. If you had a whole bunch of smart investors looking at deals, that would make sense. But then the other thing too is like, and I talked about this the other night, where with the decentralization and nobody owns enough of certain, nobody owns enough of a deal for it to want to put the work into um, certain like when you have to make a change in the business plan or something, when there's a big move to make with the property. um, when you have massive decentralization, there might not be anybody involved who it's worth their time to actually figure out what's the next move, right? Like, because okay, I just own 3% of this property, and okay, if I lose my, I could spend a long time solving this issue, or I could just lose money on that and move on to the next one. So I don't know. I see both pros and cons of decentralization. I think that the real, one of the benefits is like, okay, if I have all my money on Mogul and it turns out that the founders of Mogul are scamming me, well, then I'm in big trouble, right? Where on Lofty, like it is, I mean, I still think they have enough control where if Lofty was trying to scam us, they could. And I think we sort of saw that with them giving, signing rights for one of the DAOs away without, without necessarily a vote to give all those rights away. So I think that there is still centralized control there that creates that sort of risk. Um, so I don't know. I mean, I think there's something to that, but I don't necessarily think that is what's going to work for them. I know Jerry has talked about like they want to be like a financial services company. They want to provide other ways to innovate around the finance side. They're creating like a stable coin so you can get some yield on your reserves and whatnot. But I'm just not sure for the average real estate investor that that's going to be enough if they can't figure out ways to attract deals that don't go down in value close to 30% on average, right? I mean, and that's really like at the end of the day, like I'm here to invest in real estate. I want to see good real estate deals. I want to see deals that I'm like, I could not, for me to find this deal, the Hugo, like, my team looks on the MLS all day, every day here in San Antonio. Uh, we probably find 4 or 5 deals this good every month out of 10,000 homes on the market, right? Like it's not easy to find, and I have 4 agents working for me and me. So it's not easy to find a deal and maybe not even that many, maybe it's even less than that, So it's not easy to find deals of this quality, like that have that type of yield um, in the markets that I'd want to be in long term. Like it's not, so uh, it's challenging, and so like to just sort of like expect that the market will figure that out and bring this caliber of deal to the platform. I don't really think makes sense. Is it just going to figure out like they can, okay, we'll just start bringing like real safe deals on here? I don't know. I actually looked at, maybe just picking up some new construction here in town and putting them on there. But I think that as long as you have those deals sitting next to these like really twisted, financially engineered deals that show a 20% return, that the typical investor on Lofty right now is not going to be able to discern the difference between a really safe 6 or 7% versus, I don't mean this in a condescending way. It is, it's something that is taking a lot of time to look into the deal, right? But like, looking at a really safe 6 or 7% versus this like very tortured deal that's spitting out 20%, but is going to break the first time the wind blows. Um, I think those, that comparison is like, people are just going to keep picking the wrong one and then be disappointed, right? Because it is, if you're putting them both on your shelf, as a consumer, it looks like, even though you're not endorsing either of them, it looks like you think both of those are acceptable products, right? And it's sort of like, I know they're a marketplace, uh, but I think they really have to decide like, do you want to be eBay? Do you want to be Amazon? Do you want to be Temu? Right? Like, I mean, like those are all marketplaces. Uh, you know, Early on, I like to say, oh, they're very much like eBay. I honestly think I have more protection buying stuff on eBay than I do buying stuff on Lofty, though. If I get scammed on eBay, I'm getting a refund right away, right? If there is wrongdoing on the seller side, or even if it looks like it, we're getting protection there. So it's not that. It's certainly not Amazon, right? There's no A to Z refund going on. Maybe it's wish.com for real estate. Actually, maybe that should be their new catchphrase is we are wish.com for real estate. Or Timu or something like that where it is just like it looks too good to be true and most of the time it is too good to be true. And I think that it's a rough spot to be in, but that's where they are at the moment. Um, Man, I'm trying not to just keep putting out these negative videos on Lofty because I do want them to win. I think that I really enjoy the secondary market trading aspect of the platform. Um, and I am making great returns on it, but I just keep going back to the only reason I'm making great returns on it is because somebody else lost money. Like I don't have a single token that I bought at 50 bucks. Well, I do. I have, I guess, a couple. I that I the oh, I can't think of what it is, but like I do have a couple that I bought for around 50 bucks that are now closer to 60, or that I bought at 48 and are at like 52 and have been giving off good yields. But it's so few compared to how many I'm making money on because I bought them at 15 or 20 and I'm going to be able to sell them at 25 or 30, or we're going to sell it in real life. And so I just feel like, and I know I've talked about this a bunch, but I think more and more of you are helping me work towards this. I think we just need to get all of these trash deals off the platform. Because a lot of them, no matter how you look at them, they're just not good. Well, the way that I'm looking at them, they're not good deals. They're never going to be good deals. Like you're not going to, okay, we're going to fix it up, get a new tenant in it. It's still not a good deal, right? Like still just sell it because the value we can sell it for, when I'm looking at the cash on cash and I'm looking at the market where it's not a good, none of that is balancing properly, right? Um, so that's what I'm doing to try to help them, as I'm trying to get rid of as many properties as possible from their platform that I think shouldn't be there. If I can make any profit at all on them, that's what I'm doing. I'm buying those, and I'm working towards that. And I think we got the vote for Bowmanville to sell now, so that's good. I think that's the most recent one, but we just keep getting them, right? We just keep getting these ones that are listed for sale. Some of them, like Odom, we can't even. It seems like that sale is struggling. Um, and I don't even know what the answer for that is going to be. I've got some ideas, but all of them take more work than I'm willing to do because I only own, what do I own? Like 3.5% of that one or something. Anyway, that's it. I think rant over. Definitely though, share your thoughts on this stuff. Do you see some advantage that they have that I'm missing? that isn't dependent on somebody else lost money on their deals. I'm out trading them. I mean, maybe you can say it's the liquidity pools. I did a little bit of an experiment with that over the last day and a half. Um, Overall, that hasn't been great for me. And it doesn't seem like it's like all the people that do liquidity pools in like crypto don't seem to love them, the real estate ones, like they're not, don't seem very happy with it. So I don't know. I don't know if that's it. Um, I think as a community, we got to figure out where they fit, right? Or else, I mean, at a certain point, I'm just going to stop talking about them and be like, nope, Lofty's my spot. I'm still putting, not Lofty, Mogul's my spot where I'm investing for long term. If I want the debt, I'm still going to go to ground floor, even though they've kind of aggravated me and I've been slowly taking money off of there. Um, Maybe we need some new platforms too, right? Because I am not the person who thinks Arrived is so safe that I want to take a really subpar return in my mind. Especially because I have the option to just continue to invest in real life like I have for the last 20 years. A lot of you, I think, do too, and maybe don't realize it. Like, uh, there's people that have a significant amount of capital on some of these platforms that, like, you could be buying, $180,000 single family home here that you put 20% down. And then what is that, 36,000? Like, there's a lot of you that have more than that on the platform, and some of you that are putting big chunks into deals. And like, yeah, you can buy a brand new construction here. Um, with the builder buying down the rate and a relatively good rent to price ratio, just long term rentals and that stuff exists. My market's not the only place where you can see that. So I don't know. I think that I think that for it to make sense, like it's got to be something like this, right? Like they have to be bringing deals that are just not, that are just exceptional deals. And I don't know. I mean, I guess I could be wrong because there's, 170 plus properties that they've brought to their platform that people have invested in. But I just think that the appetite for that has to be limited over time. Um, if those aren't, if they're not making money, because like what you really are seeing is value create or destruction, right? Like you've got stuff coming to the market at 50 and now it's at 35. Like that is just, that value is just gone, right? And is it ever going to get back to 50? Maybe if we sell the property in real life, although that really hasn't even been working out. I don't know that there's been a single sale that's made more, um, that's sold for more than it was bought for, even though, and it hasn't, none of them have been held for a long time. So, over time, I think that'll change, but we don't have a ton that are in markets that I think are like real, that are real high performing markets or whatnot. So, um, anyway, I think that is it for me for today. Uh, yeah. Until next time, I'm gonna keep making mistakes. Oh, tickle the like button. Um, and that's it. Until next time, I'm gonna keep making mistakes so that you don't have to.